Hi, folks. Hope y'all are doing well today. So, last chapter we discussed chapter 7, and that kind of concepts of producer and consumer surplus and market surplus. And what we were interested in those chapters is we were interested in how do we determine how beneficial sort of market prices are for consumers or producers, and how can we tell how they're benefiting and in what ways are people benefiting from increased transactions or changes in price. Chapter 8, we're going to study a specific application of that. And the specific application we're going to be looking at in Chapter 8 is the cost of taxation. And so let's get into it. So the cost of taxation can largely be considered what we call deadweight loss. And deadweight loss is basically the fall in the total surplus that results from a market distortion, such as a tax. And the way this works is that basically our welfare without a tax is the same we saw as last chapter, an equilibrium consumer and producer surplus combined to maximize total surplus. But with a tax distorts the real equilibrium price. So the price can be in equilibrium, but with the addition of a tax, the real payment people are making is different than that equilibrium price. So, for example, let's just break down figure 3 here. Now, this might look a little complicated because we have a lot going on here, but I want to pause and slow this down, and let's just break down the components we have. So notice down here we have our consumer surplus, our producer surplus, our tax revenue, and our total surplus. So let's just go to the example of without, let me put my pointer up here. So down here, right, consumer surplus, producer surplus, tax revenue, and total surplus. Now, without a tax, note this, what we see is that what we've done is we've calculated consumer surplus and producer surplus as we've broken it down into smaller proportions or smaller areas. So for example, area A, area B, and area C, all three of these areas add up to be one triangle, which is our consumer surplus. So let me draw here just to like kind of clarify, right? This triangle here is our consumer surplus. Now, just make sure I haven't lost you. You might be saying, why is this triangle our consumer surplus? Well, one reason, particularly the price without tax. Let's find this on the left-hand side. Notice where the pointer. Price without tax, this is our P1. This is our equilibrium price. And we know that because if we follow all the way down here, we get to quantity 1, which is quantity 1. This is where quantity supplied equals quantity demanded. And so that's our equilibrium. So this is our equilibrium quantity. This is the price that creates that. That's the equilibrium price. And so in a market without a tax, we would calculate the area of this triangle, and this would be our consumer surplus. Similarly, and let me get the pencil back out, that means our producer surplus is this triangle down here. This triangle down here. And so what we have is we have broken up the producer surplus as well into 3 different components. So we have D, E, and F. So why did we break it up into these areas? We'll see in a second. But for now, let's just make sure we're comfortable with the idea that, okay, consumer surplus is the blue triangle, producer surplus is the red triangle. The blue triangle is the area below the willingness to pay, i.e. the demand curve, and above the price paid. Similarly, producer surplus is the area above the cost curve, i.e. the supply curve, and below the price received. So this seems simple enough. We go down, we check here, consumer surplus equals A plus B plus C without a tax. Producer surplus is area DEF without a tax. And then the total surplus is just adding all those areas together. So what changes with a tax? Let's just presume that in this example, we're talking about how we split a tax. So let me see if I can text here. Let's assume for this tax that we're just going to split the tax between. So let's just, if I can get the text up, yep. Let's just assume the tax will be split between consumers and producers. All right, so we're assuming that the tax is split between consumers and producers. Now, if this is the case, what we find is that if there is a tax instituted, so let's just say we put in a tax on the quantity of goods. So we were talking about last chapter video game consoles. What if the government's just like, actually, we don't think video games are like healthy for society, and we're going to put a tax on it, and we're going to put a $50 tax on every console. So every time a family goes to buy a console, there is a tax hidden in the background of this purchase, and this tax can be reflected in two different ways. In our example, we said that the tax will be split between consumers and producers, and we mean split evenly. So if a family walked up and the US put a $50 tax on video game consoles, the family would have to pay half of the tax. And so what that means is the price that buyers would actually pay is $525. All right, so just to break that down, the console was originally $500. The government institutes a $50 tax. The tax is split between the consumers and the producers, meaning that consumers will need to pay $25 and producers will need to pay $25. The way this is reflected in the market is that the price of the console would go up to $525. And so the price buyers pay equals this price PB. And notice that this is above the equilibrium price. Because it's above the equilibrium price, what that tells us is our new quantity demanded for this good at this price is this point right here that I circled in red. That is our new quantity demanded with the price after the tax. Now, similarly, sellers have to pay part of the tax as well. And so while consumers pay $525 console, the producers still need to pay $25 of the tax. And so what ends up happening is that consumers receive $475 for the console. So basically $50 is transferred to the state by the company, and the company loses $25 of their profits, which ultimately means that for the company, what I'm circling in orange, their quantity demanded goes down because their quantity supplied goes down because they are now receiving a lower price than prevails in equilibrium. And so what this means for us is that now, functionally speaking, and I'm going to clear this up and like clean this up, what this means now is that actually what's happened is we now have gone down in quantity. Our quantity has declined from Q1 to Q2. And you might be saying, well, why has it declined from Q1 to Q2? And the reason why is that quantity supply decreased from the price they're receiving going down, and quantity demanded decreased from the fact that the price they're paying has gone up. And because this quantity has dropped, what that means is we actually lose all the surplus we saw right here. So let's just look at this real quick. All of this area, right, this entire triangle has to go away. And you might be saying, well, Mr. Mickelson, why does this have to go away? The answer, quite simply, is that this area existed, this surplus generated in area C and E existed for two reasons. The first reason is that when the market was in equilibrium at the demand curve you see here, that means everyone that was willing to pay more than the equilibrium price, they just paid the equilibrium price. So they had the consumer surplus of paying a lower price than they were willing to pay. And similarly, all these people were in the market. At the higher price, everyone that was participating in the market here has now left the market. They're like, no, this is too expensive now. I was willing to pay it $500, but $525, that's just a bit too much. So this isn't worth that to me. And so all those individuals leave the market. Similarly, suppliers, there were suppliers that were willing to sell it for $500, but in this case, if we hit $475, those suppliers are like, no, at $475, I'm not interested. I'm out of the market. And so this deadweight loss occurs because we have lost both the benefits of the transactions that occurred at the lower price, and we've lost the surplus for people that were participating in that in those transactions. Now, what is our tax revenue? That actually is an intriguing question, because our tax revenue actually is simply the area of our tax times the quantity sold. So remember what we said in this example was there was a $50 tax on all the consoles. And so for every console sold, the government would receive $50 of revenue. And that revenue, that tax revenue, the price of it is the difference between the price that buyers pay and sellers receive, so that and that times the quantity of the amount of goods sold. And so the area in green, this is actually our tax revenue. So the area I've highlighted in green, B and D, this is our tax revenue. And that's because that is the tax itself times the quantity of units sold. And with this being the tax revenue, we can now conclude that with the tax, our consumer surplus is only this section A, because B is now tax revenue and C is deadweight loss. And our producer surplus is now only F, because D is the tax revenue and paid by suppliers, and D is the deadweight loss they've incurred. And so you can see all these changes broke down in this bottom table. And that is how a tax affects welfare. Now, something I do want to consider here and pause before we continue from here is that you might be wondering, does this change with inelasticity? Because we talked about last chapter, and the answer is yes, it does, and we will see that in a second. So deadweight losses and gains from trade. Note the losses incurred by consumers and producers exceeds the tax revenue generated for the state. Taxes cause deadweight loss because they prevent buyers and sellers from realizing some of the gains of trade. Note, this is not like specialization, which we discussed in chapter 3, but more so from the gains of the transactions lost. Again, sticking with the phone example, so we've talked about iPhones a little bit. Think about how iPhones were impossibly unaffordable. The cheapest one was like $850. Less people bought iPhones, which means there was less surplus for people purchasing iPhone phones, meaning Apple was simultaneously worse off, and individuals that would have bought iPhones couldn't at the prices were also worse off. And so Apple re-released more affordable phones to fill out their line to ensure that people that want to own an iPhone can have an iPhone. Now, what are the determinants of our deadweight loss? Simply put, inelasticity is what determines our deadweight loss. So I just want to look over here, and we're going to zoom in on this. So deadweight loss due to taxation is a function of the elasticity of demand. So in this case, we're looking particularly at demand. And note that if we institute a tax on suppliers, suppliers shift leftward. And the reason for this is that, one, the suppliers, basically a tax is considered an increase in their factors of production, and that leads to a leftward shift. And so supply shifts, and we notice that supply shifts leftward fairly significantly, but notice that the quantity demanded does not particularly change that much. Notice that the quantity demanded is actually very flat. And so our dead weight loss is actually fairly small. So let me make sure I can get this little pencil out here. Yep. So our dead weight loss is actually only this little triangle here that I'm drawing in. And the reason why is because with a inelastic demand and consumers are who pay most of the tax. And so and because their quantity demanded hasn't changed that much, that means the deadweight loss is relatively low. And so I mentioned in the last chapter sin taxes, and sin taxes are taxes on behavior the state views as harmful. And so tobacco and cigarettes, well, these things tend to typically be addictive as well. And so a tax placed on these things don't necessarily lead to a dramatic decrease in quantity like we see here. The differences in quantity is not substantial, but the price hike is significant. Now, in contrast, if we have an elastic demand and we put a tax on the supplier, supply shifts leftward. And notice that actually, and think of our, look at how flat our demand curve is. Notice that actually deadweight loss now is very significant. And the reason deadweight loss is very significant with an elastic demand is because remember what elasticity told us? It told us how much does our quantity demanded change in response to a change in price. And so if a tax is instituted and that raises the price of the good and elasticity is high, what that means is that there is a more significant drop in the amount of people no longer buying the good than the increase in the price of that good in general. So notice too that in the example of notice too that in the example of elastic demand curve, so we have the flat demand, yes, the deadweight is also huge, but also who's paying the tax? Right. Notice that producers are who pay the tax in this case. They have to shoulder more of the tax, And what ends up happening is that supply significantly decreases. So that's how they compensate for the increased price. Ooh, let me get this down here. So notice like just a modest price increase, but most of the burden is shared by quantity decrease. All right. So with that, let's consider also the elasticity of a supply curve. So notice that this is an example, the first example is an elastic supply curve, and this is where the decrease in demand is actually roughly equivalent. So demand, we're putting a tax on consumers at this point. We have a leftward shift in demand. So let's draw this leftward shift. We have this leftward shift in demand. And so with the decline in demand, we'd expect, of course, a lower quantity. And in fact, we do have a lower quantity, right? We see that the quantity in equilibrium goes to the new quantity with tax. But notice that the supply is fairly unit elastic, actually. And because the supply is fairly unit elastic, what that means is that, and how do we know it's unelastic? Sorry, let me pause here. How do we know this is unelastic? That's a nearly 45-degree angle. And so 45-degree angle means that the elasticity is about 1. And if elasticity is about 1, that means the change in price leads to a direct change in the quantity demanded. So if price increased 5%, then quantity demanded decreased 5%. In this example, because supply is unit elastic, what we see is the dead weight loss here is actually evenly split between the two. So no one's really more elastic than the other, and so we have a fairly split burden of tax incidence. In contrast, if we look over here on the right, we have an inelastic supply curve. What happens with the inelastic supply curve and the demand shift? What ends up happening is that the price with the tax is less significant. So notice that the price in equilibrium barely goes up for the price with tax, and that's because supply is the more inelastic curve. Since supply is inelastic, they wind up shouldering more of the burden than the consumers do. And so we actually have a very modest decrease in the quantity in the market. So we move from the quantity equilibrium to quantity tax, very small, modest. But the dead weight loss is largely shouldered by suppliers. And again, just as we said for consumers and in the case of cigarettes, in the case of producers, if producers are who are more inelastic, that means they're going to be the group that shoulders more of the burden. Now, what this leads to is an actually really interesting question in tax policy. And the answer is, how do you maximize tax revenue? Because we basically provide an example, right, that if the markets are fairly inelastic and you don't lose a lot of quantity, then you can generate quite a bit of tax revenue with minimal dead weight loss. However, if your markets are very elastic and you institute a tax, that means you can distort the market significantly and you can actually garner much less tax revenue because you had a significant impact on the elasticity of the market. Dead weight loss and tax revenues vary. And so the size of the dead weight loss is dependent on the size of the tax. A small tax has a small dead weight loss than a medium tax and a large tax. And this relationship leads to something that we call the Laffer curve. And this is our Laffer curve. I want you to notice there's 3 curves here. Let's focus on simply put, the black curve in the middle here first. So notice that this is just kind of a simple, straightforward curve, and that this curve kind of goes up. Basically, what this curve argues is that you maximize your revenue at a tax percentage rate in the middle of whatever your 2 options are. And so to explain the intuition here, if the government has a tax rate of 0%, presumably their tax revenue would then be also 0%, right? If the government doesn't tax, then they don't collect tax revenue. That's simple enough. So that tells us that your tax revenue at 0 is 0. Meanwhile, if the government taxed 100%, would the government's tax revenue be higher or lower? And the answer is that the Laffer curve presumes that no, the tax is actually going to be, well, 0. Tax revenue will go to 0. And the reason the tax revenue will go to 0 is because no one will work. If the government just taxes everything you make, then what incentive do you have to be working in the market? Now, this seems simple because, again, we just made the assumption that Therefore, the tax revenue is highest in the middle. In reality, we're not sure where the tax revenue is the highest, and that gets us the following points. The red curve here suggests to us that actually quantity is very elastic, and that the government, by accepting a lower tax revenue, maximizes revenue, because the loss of quantity at a higher tax rate would lead to an overall lower tax rate or lower tax revenue generated. Meanwhile, the blue curve assumes that actually labor and fairly inelastic and demand is fairly inelastic. So therefore, higher taxes lead to higher government revenue. These curves aren't red and blue for a reason. The left curve, the lower tax curve, this is typically a curve embraced by more conservative economists. Their argument is that a lower tax rate, because quantity demanded is fairly elastic, you generate higher revenue by letting markets grow and collecting taxes driven by the gains from trade instead of the percentage levied. More progressive economists see the Laffer curve as the blue curve, and that is the idea that actually no, quantity demanded is fairly inelastic, which means that the best way to generate revenue is not to count on the gains from trade at lower prices, but to gain revenue from taxing the already purchased goods at a higher rate. And so I highly recommend read the tax debate in your text. This is big names in economics making really great points. But for today, folks, this is everything we have for you. So we're going to pause here and see you next chapter, which will be about taking what we've talked about in consumer and producer surplus and applying it to the context of trade. All right.